Thanks, Dan. Hi, everyone. Thanks for joining us today. Just our quick standard disclaimer, this presentation is for educational purposes only. It is not legal advice and does not create an attorney-client relationship. We'll have some information on the end on contacting us if you have specific questions. So you can keep things moving with your day. We'll try to get through this information somewhat quickly and try to get you some useful stuff, but get you back out into your workday as well. So today, as noted, we're talking about the Fair Labor Standards Act, the FLSA. For those of you who've been with us a while, we've talked about this topic before, but it's important enough that it warrants definitely revisiting periodically, just as a refresher. It's a big topic and it's an important topic, and checking in with it from time to time is very important for employers. It's a very broad law. We're not going to cover every single aspect of it, but we will hit many of the high points. Just as kind of a side note, a lot of the topics that we're going to briefly discuss today could completely be webinars on their own. There's enough to drill down into on these topics, but we're going to just take kind of a high level approach, but still provide you with some useful information for your business. We really want to make you aware of the broad rules so that you can look at and make sure you're complying with the law inside your business. So the FLSA is the primary federal law governing wage and hour standards for most full-time and part-time workers in both the public and private sector employment areas. The law establishes minimum wage and overtime pay requirements, but it also does a lot of other things. It lays out rules for record keeping, stuff for child labor restrictions, and a variety of other workplace standards are covered by the FLSA. The Department of Labor, through its Wage and Hour Division, administers and enforces the Fair Labor Standards Act. The DOL has issued a lot of implementing regulations and interpretive bulletins regarding this. Some of those materials don't have the force of law necessarily, but they are useful for employers to understand their obligations, and they are also used by the courts if they're deciding an issue under the Fair Labor Standards Act. So all of the regulations and bulletins that are put out by the DOL are useful to know about for employers. So as kind of a starting point, let's talk about who or what is covered, meaning which employers, which employees are covered by the Fair Labor Standards Act. Just as kind of a starting point, most private employers are covered by the FLSA. That's definitely our target audience here. We're not going to split hair on other types of employers that may or may not be covered. We're not going to really talk about a lot of government employers, things like that. We're going to focus on private employers today. That's our primary audience. So most private employers are covered under the FLSA. If you have a question on specific coverage, that's something about your company, that's something that you can reach out to us through a ticket. Employee coverage. There's a couple of different ways that, in addition to an employer being covered, an employee might be covered by the FLSA as well. They could be covered based on their work, which is known as individual or individual coverage, or they could be covered based on the nature of your business is the employer. In other words, enterprise coverage. Enterprise coverage exists for employees under the FLSA if the employer is both engaged in commerce. So think about engaged in commerce. That means you're doing business basically, or if the employer produces goods for commerce. I mean, this is somewhat of an older definition, production of goods. There are so many more things that an employer does now, so many service industries that are out there, everything from construction to software. Those wouldn't necessarily be the production of goods, but they would certainly, those businesses would fall back under the engaged in commerce piece of the definition for an employee to be covered under enterprise coverage. In addition, enterprise coverage could exist if the employer is engaged in commerce or production of goods and they have gross annual sales or volume of business of at least $500,000 a year. That covers a lot of even small businesses. They do at least 500 a year in business. So yeah, enterprise commerce could easily exist for your employees. The other area where an employee might be covered by the FLSA is if there is individual coverage. So an employee could be covered individually if they are doing work in commerce. Okay, so what does that mean? That's a super easy burden for an employee to meet in order to be covered by the Fair Labor Standards Act. It's argued that things such as receiving mail, receiving physical mail, using the telephone, sending and receiving email for the business, those things would be considered to be in commerce or interstate commerce because those communications can cross state lines. That makes them interstate. So that generally really lowers the burden for an employee easily being covered by the Fair Labor Standards Act under individual coverage. So it's a pretty safe bet that if you have employees that are using the phone, using, sending and receiving email, or even looking at physical mail, talking with people across state lines, that's going to put them into commerce. So which workers are excluded, however, we've talked about the businesses that are covered, we've talked about the employees that are covered, which workers might be excluded from coverage under the Fair Labor Standards Act within your workforce. So if you have independent contractors, for example, they would not be covered by the Fair Labor Standards Act. Again, Fair Labor Standards Act meaning, minimum wage and overtime. The whole thing with under federal law, the whole definition and the whole idea with independent contractors is sort of in flux right now. Generally, the tests that are out there are different federal tests. They look at control, permanence of the work relationship, difference in what services are offered. That's all sort of changed under the new federal administration. Basically, we're operating under an older rule right now, the economic realities test. So that's just kind of something to file away. If you do have questions on whether an employee or whether a worker is an employee or an independent contractor, certainly let us know. So independent contractors not covered by the FLSA. Interns are not covered by the FLSA, but special rules apply to make sure an intern is actually not an employee. There's basically a 7-factor test that would be used under the Fair Labor Standards Act. So that is something to consider in your workforce. If you're wondering, I want to bring on this person as an intern, are they actually an employee? That's something you'd want to run by us. To be an intern, generally there has to be academic credit. The work has to be tied to a specific program. The work of the intern doesn't replace the actual work of another employee. Those kinds of factors come into play. Another area that is not covered as an employee under the Fair Labor Standards Act would be volunteers, and that's an individual who engages in an activity solely for their personal purpose or pleasure without any promise or expectation of compensation. Again, that's kind of specific criteria. You want to make sure if you have people that are volunteers, quote unquote, within your workforce, that they're not actually employees that would be covered under the Fair Labor Standards Act. And then finally, trainees, they are not covered by the Fair Labor Standards Act if they meet the definition of trainee. So those are individuals participating in like a pre-employment training program where they're trying to learn a particular skill. The training is often, again, pre-employment and provided by and required by the prospective employer. Be careful with that as well. But those are examples of folks that would not be covered under the FLSA. Some other areas that are covered by the FLSA, we'll just talk about these briefly. We're going to focus on some kind of core topics, but these are worth touching on. Again, this is a very broad law, and these are things to be aware of within your business that could be affected by the Fair Labor Standards Act. First is tipped employees. There are special rules that apply under the FLSA for workers who receive tips. There's rules regarding tip credits and tip pooling. That is a whole area unto itself. That could be a separate webinar at some point, but that's something to be aware of, that it is affected by the Fair Labor Standards Act. Child labor is covered by the Fair Labor Standards Act. So the age of workers, the hours and days of work, whether work can occur when school is in session, what are the rules regarding agricultural work? Those are some of the areas touched on by the FLSA with child labor. There are equal pay laws to consider under the FLSA. The Equal Pay Act, or the EPA, is an amendment to the FLSA that prohibits sex-based wage differentials for employees in the same workplace performing similar jobs. So you cannot pay men and women differently for doing the same work under the EPA portion of the FLSA. Breaks for nursing mothers, that's another area that's covered under the FLSA. You need to provide a reasonable time and place for nursing moms to pump if they need to. That's an area that's a little bit newer, but it's something to be aware of. Employer record keeping and posting requirements are also part of the FLSA. Employee records that must be kept under the FLSA include the employee name, their address, their sex, their work week, their rate of pay, their hours worked, their straight pay, their overtime pay, their deductions from pay, things along those lines. You're also required to post a poster that covers, a federal poster that covers the FLSA requirements in the workplace. And then another area that's covered by the FLSA is litigation. The FLSA authorizes litigation by individual plaintiffs or in class form in a class action. Really what we're going to focus on today are sort of three main areas that we get probably the most questions on regarding the FLSA related topics. So those are minimum wage and overtime. So we're going to talk about the regular rate of pay and some overtime calculations just so you can be familiar with that. We're going to talk about compensable time. What is paid time for an employee and what is not paid time for an employee? And we're also going to talk about exemptions to minimum wage and overtime laws. We're going to primarily discuss the executive, administrative, and professional exemptions. Those are also referred to as the EAP exemptions or white collar exemptions. Those are the most widely used and most applicable to private employers. So within our audience, those are sort of the big areas that we are going to focus on today. All right, let's start with the Fair Labor Standards Act and minimum wage and overtime. The federal minimum wage is currently $7.25 per hour. Just in case you're wondering, no increase is expected under the current federal administration. Overtime pay under the FLSA occurs for all hours worked over 40 in a work week. And that overtime pay must be paid at a rate of at least 1.5 times the employee's regular rate of pay. So somebody's regular rate includes all remuneration or pay for employment paid to the employee. So that includes base pay, their commission, shift differentials, bonuses, etc. I also need to emphasize that overtime is based on a work week, not a pay period under the Fair Labor Standards Act. So let's define a work week. That is a set period of 168 hours, in other words, 7 days, that the employer sets. Once you've set a work week, you should not change it because the Wage and Hour Division of the USDOL, who enforces the FLSA, will not look kindly upon that if they think that you're moving your work week around to avoid paying overtime to your non-exempt employees. An employer cannot average out over a pay period that's longer than a work week as defined by the FLSA. So what do I mean by that? Again, overtime is calculated for each work week under the FLSA, that consecutive 168-hour or 7-day period work week. So say an employee works 50 hours in one work week, and then in the next work week, they work 30 hours. An employer under the FLSA cannot average the 2 work weeks out to 40 hours each week to avoid paying overtime under a 2-week pay period. The issue would be that during one of the work weeks, which is required by the FLSA, the employee had worked 50 hours, which is more than 40. So the employer would be required to pay 10 hours of overtime for that work week. They could not average out the 50 hours one work week, the 30 hours another work week within a pay period to say, oh, the person only worked 40, averaged 40 each work week, so then I don't have to pay overtime. You cannot do that. Again, any changes to your work week once you have set it will bring scrutiny under the FLSA, and generally the reason that people might change their work week would be they got bought by somebody, or they bought somebody, and there's a consolidation of workforces, and it would be like a one-time event. Otherwise, a work week is generally not changed. I'm going to run through just a quick overtime calculation example. This is very simple, but it's something that we do get questions on, and it kind of illustrates how this all works. So say you've got a non-exempt employee earning 10 bucks an hour. Again, non-exempt means they're eligible for overtime pay. Say they work 50 hours in a work week. First, you want to find the overtime pay rate, which is the regular rate of pay times 1.5. So $10 per hour regular rate of pay times 1.5 equals $15 per hour. Then you want to calculate the regular pay and the overtime pay. So this employee worked 40 hours at $10 per hour, so that's 400 bucks regular pay. They also worked 10 hours at 15 bucks an hour, which is overtime pay. Add those two numbers together to determine the employee's gross pay. So 400 of regular pay plus 150 of overtime pay equals $550 in gross wages. Again, this is a super straightforward example. Things can definitely get more complicated. You could have blended rates of pay. That means more than one rate of pay during the work week. Say an employee within your business performs 2 different jobs during the work week. They get paid 2 different rates for the 2 different jobs, and you've got to do a blended rate. Other compensation has to be included sometimes too, such as a non-discretionary bonus. This can get tricky, especially if the bonus period is stretched out over more than one work week. If that occurs, an employer might have to go back and true up the employee's regular rate of pay to reflect the bonus paid at some point down the road. Again, these are questions we get. These are stuff that we can help you with, but I just wanted to give you this kind of straightforward example of how this really does work. Here's another area that we get quite a few questions on from our clients. What is compensable time, or when is certain type of time related to an employee compensable? Some of the areas that we touch on are shown here: the meal periods and rest breaks, waiting time, on-call time, sleeping time, trainings, lectures, meetings, travel time, donning and doffing of work-related clothing, and security checks. So we're going to kind of go through these and discuss them a little bit here. Let's start with meal periods and rest breaks. Kind of a important thing to note is that the FLSA does not require employers to offer meal periods or rest breaks. If provided, however, the compensability of the meal periods or the rest break depends on factors such as the length of the break and whether the employees perform any work during that time. So for example, under the FLSA, a rest break of 20 minutes or less is considered compensable time. So federal law, wage and hour issue, a rest break of 20 minutes or less is compensable. Meal periods are generally 30 minutes or more, and they are not compensable if the employee is relieved of all duties and performs no work. Those are just kind of a couple of general broad rules regarding meal periods and rest breaks. What about waiting time? Well, under federal law, it kind of depends. If an employee is quote unquote engaged to wait, the waiting time is generally compensable. For example, say like a security desk employee is sitting at the desk, they're reading a book between visitors. At that point, they would be considered most likely engaged to wait. Those periods of times of inactivity are compensable under the FLSA. However, if the employee is waiting to be engaged, the time may not be compensable. An example would be an employee completely relieved of all duties until a specific return time. They're free to use their time for personal activities. If those circumstances are in place, they're waiting to be engaged, and that time would not be compensable. That's something, again, to look at on a case-by-case basis. We get questions on this stuff, and we can certainly help you if you do have a question. Another big area that we have is on-call time or standby time. And again, we're talking about the federal law here, Fair Labor Standards Act. An employee is required to remain on call on the employer's premises is working while on call. An employee who's required to remain on call at home or who is allowed to leave or where they can have a message put out where they can be reached, they're not working in most cases while on call, so that time's not compensable. You do have to look at to what extent the employee's freedom is restricted to sometimes answer the question on whether or not the on-call time would be payable to the employee. Another big area we get questions on involves travel time. Generally speaking, the compensability of travel time will depend on the type of travel that the employee is performing. For example, a normal home to work travel or their commute is generally not working time, but travel from a job site to another job site during the workday typically is compensable. Again, these are just kind of broad examples. Let us know if you have specific questions on things through our portal. Donning and doffing of work clothes. So whether or not the time spent putting on and taking off, safety clothing, work-related gear, whether or not that's compensable generally depends on the circumstances. It also might depend on what federal jurisdiction you're in terms of federal courts, because some of the federal courts have set up different rules regarding when putting on work clothes or removing work clothes are payable. Could be location specific because some courts have interpreted the FLSA in different ways, so that could affect whether that time has to be paid to employees. Security checks, thinking of somebody leaving your work site and getting their bag checked to make sure that they're not taking any of your items with them. Courts generally treat that time spent waiting for and passing through security checks as not compensable, but again, it could be location specific. There can be exceptions in certain areas. Another area where we get a lot of questions regarding compensable time are lectures, meetings, and training sessions. This one is fairly locked down, I would say, under the FLSA. The time that an employee spends at a lecture, a meeting, or training does not have to be paid to the employee only if all 4 of these conditions are met. In other words, if any one of the 4 is not met, that time is paid. So in order to not pay somebody for, say, a training session, it has to be outside of normal working hours, it has to be voluntary, cannot be job related, and no other work can be performed at the same time. Again, if any of these 4 are not met, then that time has to be paid. A lot of what we see is the time is paid because the training is work related. That is one of the 4 factors, and because that generally is in place, the employees mostly have to be paid for any training. Sleeping time, this is kind of a strange one. You see this depending on the different industries, maybe home health care or general health care, things like that. Whether or not sleeping time of an employee is compensable generally depends on factors such as how long the employee has to be on duty, whether the employee is residing on the employer's premises during their shifts. Again, you'll see that a lot in the healthcare industry. So that's, we have a lot of clients in that area. We do get questions on that. So this is just something to kind of be aware of as it relates to the FLSA. Here is another really big question that we get. It involves the status of an employee. Are they an exempt employee, meaning they don't have to be paid overtime? Or are they a non-exempt employee, meaning they have to be paid at least minimum wage and then overtime for all hours worked over 40 in a work week? Exempt employees have to meet certain criteria. They have to be paid by salary. The salary must meet the minimum salary level required, and they've got to meet the primary job duties test. Looking at this issue overall, the DOL, again, the federal agency that administers the Fair Labor Standards Act, they have a saying, all employees are born non-exempt. That means that all employees are covered by the FLSA and must receive at least minimum wage and be paid overtime for all hours worked over 40 in a work week, unless the employer can prove that an exemption to the FLSA rules apply. So that's the presumption with all your workers as far as the FLSA is concerned. When you're looking at classifying them as exempt or non-exempt, you have to start with the presumption that everybody is non-exempt, and then you work backwards from there to see if an exemption might apply. Generally, exempt employees are those who don't have to be paid minimum wage and overtime under the FLSA. There was supposed to be, and we'll talk about this in a little more detail, there was supposed to be a big change with the minimum salary level required for exempt employees. That got shot down, but we will go through some of that in more detail as we go through this, this topic. So, salary level. Salary level for an exempt employee currently is at $684 per week or $35,568 per year. Last year, several rules were in place that were supposed to change those numbers. And in fact, up until November 15th of 2024, the salary level for exempt employees had increased to $844 per week or $43,888 per year. And as of January 1st of this year, those numbers were supposed to go up to $1,128 per week or $58,656 per year. So what happened back in November of 2024 that changed that? Well, a federal court struck down the 2024 rules for the salary increases that we just discussed. The court thought that the DOL had overreached on its rulemaking, and so those proposed salary level increases, again, $43,000 per year and $58,000 per year, were shut down. So now the salary level as shown on the screen is back to the 2020 amount, which is $35,586 per year. In other words, $684 per week. And it's not clear if the DOL will appeal this decision, especially with the new federal administration. So it's not sure at this time what's going to happen with the exempt salary level, but that's just something to keep in mind, that we're back to a previous lower level. Another requirement for an exempt employee is to be paid on a salary basis. And what that means is the employee must regularly receive for each pay period on a weekly or less frequent basis a predetermined amount constituting all or part of their compensation. In other words, they have to be paid a weekly salary. That predetermined salary amount can't be subject to reduction because of variations in the quality or quantity of someone's work. What that means is somebody does a bad job and you classify them as exempt, you can't knock down their salary. If somebody misses a day of work, you can't knock down their salary for that work week, with a few exemptions or exceptions that we'll discuss shortly. If an employer has an employee that they've classified as exempt and they make improper deductions from the exempt employee's salary, they're going to lose the exemption for that employee, as well as anybody else in that job classification might lose their exemption as well, which would mean it would open people up to receiving overtime. So an employer, when classifying an employee as exempt, has to be very careful with their classification process, number one, and number two, has to be very aware of the salary basis requirement. Now, some of the permitted deductions from pay that an exempt employee can go through under the FLSA include things required by law, such as maybe payroll taxes. If an employee has gone for a full day absence for personal reason other than sickness or disability, if there's a full day absence for sickness or disability under the employer's sick time plan, if there's an offset for an amount received for jury duty, for example, or military pay, there could be a deduction from an exempt employee's salary for a penalty for a safety infraction. There can be a deduction in salary for an exempt employee for a full day disciplinary suspension. Also, during an exempt employee's first week of employment and last week of employment, they don't need to be paid their full salary. Or if an employee is taking FMLA, again, federal leave, Family Medical Leave Act leave, that can also affect their salary level. But other than that, deductions from an exempt employee's pay are not permitted. Another area to look at in determining whether someone is exempt is the primary duties. That means the principal, main, major, most important. Generally, they have to take up more than an employer's 50% of their time. Determining of an employee's primary duty requires a pretty fact-specific analysis. You've got to look at the relative importance of the employee's exempt duties compared to other non-exempt duties they might do. You have to look at the amount of time spent performing the exempt work. You have to look at the employee's freedom from supervision, and you also need to look at the employee's relationship to their salary and the wages paid to other employees for non-exempt work. In other words, you can't load up an exempt employee with non-exempt duties and still call them exempt. Let's talk about, again, the white collar exemptions, each one individually, the executive, administrative, and professional. We'll talk a little bit about each one just to give a little more depth. Those are the primary ones that we see in private industry. Those are the primary ones that our clients use. And so we're going to focus on those today. We'll start with the executive exemption. Again, everybody's paid a salary for the work week. Keep that in mind. The salary has to be at least that $35,000 level. But let's talk about the duties. With an exempt employee who's under the executive exemption, they have to be an individual that's responsible for the success or failure of the business. So management is their primary duty. They've got to either manage the whole business or a recognized part of the business. They've got to direct the work of 2 or more full-time equivalent employees. They have to have the authority to hire and fire, or alternately, their suggestions and recommendations regarding hiring, firing, advancement, and other change of status would be given particular weight by the ownership of the business. So that's the executive exemption. Administrative exemption is one we get quite a few questions on. It can sometimes feel fairly wide open. There's a lot of data that goes with it. So we want to kind of go through some of these pieces as it relates to it. Again, remember, for the executive, administrative, and professional people, they must be paid the salary each work week, and the amount must meet the threshold. So with the administrative exemption, primary duties, there's actually 2 broad swaths of primary duties to look at when you're considering classifying an employee as exempt under the administrative exemption. The first primary duty is performing office or non-manual work directly related to management or general business operation. We have seen with clients of ours that work, say, maybe in the construction field, they have a very skilled individual that serves in title as a manager. However, because that person also performs manual work, even if it's very skilled manual work, they often cannot be classified as exempt because of that manual work rather that they perform. So that's just kind of an example of when we say non-manual work. That truly does mean non-manual work. Some examples under primary duty 1, where someone could be considered an administratively exempt employee, could be working with tax, finance, accounting, budgeting, auditing, maybe insurance, quality control, purchasing, procurement, advertising, marketing, research, safety, personnel management, benefits management, human resources, labor relations, computer network, some database work, legal, regulatory compliance. Those are areas where somebody might be looked at for the administrative exemption. That's primary duty 1. Primary duty 2 requires that the employee also include exercise of discretion and independent judgment with respect to matters of significance. That's kind of a wordy and kind of nerdy statement that comes out of the FLSA. But that basically means that the person has the authority to formulate, affect, interpret, or implement management policies or operating practices. The person carries out major assignments for operations of the business, or they perform work that affects business operations to a substantial degree. Really what this means is it can come down to more of an art than a science. There is not always necessarily a bright line test if you're looking at using the administrative exemption for somebody. You've got to look at everything globally and apply it to what the person is actually doing to come up with a determination on whether or not they would meet that administrative exemption. So you want to look at primary duty 1 and primary duty 2 with an administrative exemption. Professional exemption. All three of these primary duties must be met. Performing work requiring advanced knowledge. So that generally means somebody who maybe is an accountant, they're an attorney, a teacher, an engineer, a doctor, maybe they work with biological matters, they work in the chemical industry, they work in another area of physical sciences. Those are areas that are recognized as potentially being professional exemption meeting positions. Their knowledge of the individual must be in a field of science or learning. So again, it could be maybe an architect, something like that, where it's very specialized. And the knowledge is customarily acquired by a prolonged course of specialized intellectual instruction. So a lot of times you've got to look at somebody with a titled position if you're going to be using the professional exemption. So this is a sort of an important matter that we see crop up frequently. What if exempt or non-exempt is not clear with a worker? Well, we work through these questions frequently, and there's kind of a roadmap that you can use to get you to a place where you can make a decision. Start with the pay method. Again, the person must be paid by salary, has to be the same amount each week. Right now, again, $684 per week or $35,586 per year, at least that amount. And the salary can't be reduced due to the quality or quantity of work. Next, you want to look at the primary job duties. Executive, administrative, and professional, as we've just discussed, the EAP or white collar exemptions, those are the most common we see in private industry. The primary job duties for the exemption must generally be performed at least 50% of the time. That's just kind of a rough figure. So you want to start with how they're paid, how much they're paid, and then what they do. We actually have a worksheet that we can provide to clients that kind of helps walk you through that process. It lists out the different requirements for each of the exemptions. That is a useful topic, but that's sort of the roadmap. And why do we care? What's the issue of whether someone's exempt or non-exempt? And say, we misclassified them. What's the issue there? Well, there's a lot of risk with misclassification, a lot of financial risk. If somebody who is actually non-exempt has been misclassified as exempt, that can lead to some problems for an employer. There could be things like having to pay back overtime, back wages. There can be liquidated damages. There can be fines. There can be penalties, and there could be attorney's fees that an employer could be subject to. And with the FLSA, there potentially could be criminal sanctions if the misclassification was deliberate. In other words, the employer knew the person was truly non-exempt. They classified them as exempt anyway on purpose to avoid paying overtime. If they did that deliberately, there could be criminal sanctions. If you have a misclassified worker, somebody is classified as exempt, but they should be non-exempt, that has a ripple effect upon your business. It could hurt the classification of other employees who you've called exempt within their classifications if they're similar to the person who's been misclassified. That's one thing to be aware of. As again, we discussed before, you could lose an exemption for an entire class of workers with a misclassification issue. If you're not sure and you want to be cautious, it's always okay to classify the employee as non-exempt. Pay that person at least minimum wage. If the person works over 40 hours in a work week, pay them overtime. Again, it's worth repeating that the DOL starts with the presumption that a worker is non-exempt. So they don't have a problem with you if you just classify somebody as non-exempt and pay them at least minimum wage and overtime. That's not an issue. We touched on this before, but we want to talk about how bonuses can fit in to an exempt employee's salary. So I've just kind of put together just some basic math here to illustrate this idea to you. But if you have an exempt employee and that person receives part of their salary, their required salary as an exempt employee as a bonus or bonuses throughout the year, there are rules that you have to be aware of. Basically, you've got to make sure that the employee receives at least 90% of the exempt salary threshold through their regular pay, not through bonuses. That means that up to 10% of the required salary level could be paid in a bonus or bonuses throughout the year. With the current salary level for exempt employees, that could mean up to $3,500 roughly per year could be paid to an employee as an exempt employee as a bonus, and they could still maintain their exemption. But you've got to make sure that you're not trying to credit more than that amount towards that exempt salary threshold. It's okay if somebody is making above the exempt salary threshold, you're paying them extra bonuses, they're making more money, but you've just got to make sure that no more than 10% of their exempt salary threshold level is through a bonus. That's the purpose of this slide, is to illustrate that point. Okay, we're talking about the Fair Labor Standards Act. Again, a very broad federal law covering all types of issues. We focused in on a few specific issues, the most important ones we see regarding the Fair Labor Standards Act, including exempt employees, including compensable time, those sorts of things. That's only one piece of the puzzle for you as the employer. This is a question we get all the time. What about the state and local laws? We know we need to comply with the federal law. We're guessing that we need to comply with the federal or the local and state laws that apply to us too. Is that correct? And our answer is yes, of course that's correct. So a lot of state laws cover the same subject matter as the Fair Labor Standards Act, such as minimum wage, overtime, exempt salary threshold, but you're running your business, you're aware of the federal law, you're complying with the FLSA, you've got to take that extra step and then look at the state or states where you're operating, and even in some cases, the city or county where you're operating, to hit some of the other wage and hour law requirements that those jurisdictions have for you. Again, the state, the county, the city. Local minimum wages can be very different, or state minimum wages can be very different than the federal level. Again, the federal minimum wage is $7.25 an hour, but look at the states or look at the cities that have much higher minimum wages, and it's all across the political spectrum as you're looking at states. For example, South Dakota's minimum wage is $11.50 an hour. Vermont's minimum wage is $14.01 an hour. So you've got the federal, you've got the state, where you're going to have to pay the state minimum wage if it's higher than the federal, because that's the one that's more beneficial to the employee. Also, some of these bigger cities that you may operate in, they have their own minimum wage. The city of Seattle minimum wage right now is $20.76 an hour. Los Angeles city minimum wage, $17.28 an hour. That's a factor that is needs to be considered when you're looking at minimum wage work for your workers. There can also be a daily overtime requirement that employers need to meet. So under the FLSA, overtime is paid after working 40 hours in a work week. But a lot of states have daily overtime requirements, including Alaska, California, Colorado, and Nevada. So California requires overtime pay after 8 hours in a workday and after 12 hours in a workday at different rates. Colorado requires overtime pay after 12 hours in a workday. Alaska and Nevada require overtime pay after 8 hours in a workday. So there's all kinds of overlay on top of the FLSA that could come into play with your business. There can also be a day of rest requirement, such as requiring that all employees have 1 day off for every 6 days work. The FLSA doesn't have that, but a lot of states have that day of rest requirement. So after an employee's worked a certain number of consecutive days, they need a day off. They can't be scheduled. That includes California, Illinois, Kentucky, Maine, North Dakota, New Hampshire, New York, Rhode Island, Texas, and Wisconsin. Again, that is a broad swath of states with differing, political parties in control, differing philosophies, but they all have that day of rest requirement. State or local laws can also affect meal periods and rest breaks, including the length of the break and at what point in the shift the break must occur. Again, under the federal FLSA, there's no rest break requirement, but if an employee takes a rest break, it's payable if it's 20 minutes or less. California wants to pile on top of that rule. They've got all kinds of rules relating to rest breaks and meal periods. So an uninterrupted 30-minute unpaid meal period is required when somebody works more than 5 hours a day. If they work more than 12 hours a day, they get another 30-minute meal period in California. They also get a paid 10-minute rest period for every 4 hours worked. That's just something to be aware of. Another area to look at is overtime pay exemptions. Their duties test might be more stricter in a state than it is under the FLSA. We just talked about how important it is to make sure under the FLSA that an employee you classify as exempt is actually exempt based on the work they do. Well, depending on the state or states you operate in, they could have an even more strict test for classifying a worker as exempt. And that's something that you've got to be aware of. They could also have a much higher salary level for an exempt employee. For example, we're going to pick on California again. Their state requirement of pay for an exempt employee is $68,640 per year. That's almost twice as much as the FLSA level of $35,000 and change. Also, Alaska, Colorado, New York, they have different rules on whether or not an employee can be classified as exempt. That's different than the federal law. Some states may have wage statement or pay stub requirements. They can be very steep. They can lead to penalties for an employer if those pay stubs are not given to employees and if they do not contain the correct information. There are whole law firms in California that specialize in, hey, did your employer give you the wrong pay stub? If so, we will sue them for you. It's crazy. So that's an area you need to be aware of under state rules. Another big area to keep in mind with state rules are vacation pay laws. If you provide vacation, does it have to be paid out when somebody leaves? Generally speaking, providing vacation is not required. The only exemptions I can think of would be if you're in a paid leave for all type of state, where there's Nevada or Illinois, for example, have laws where you have to provide paid time off. The employee could use it for anything, not just sick time. That includes vacation. But outside of that, if an employer is voluntarily providing vacation benefits to employees, the FLSA is not going to touch that topic, but your state laws definitely could. For example, again, California, if you've awarded somebody vacation, it can't be forfeited. So you can't have a use it or lose it policy. You can't say the balance isn't paid out when they leave. Their vacation time has to be paid out. That's outside of the FLSA, but that is an important thing to think about depending on where you're working. Paid sick leave laws also come into play. Again, not required by the FLSA, but many states have paid sick leave. Final pay. There can be rules under state law of when somebody has to receive their final pay. How about equal pay? Now, the FLSA contains the Equal Pay Act amendment that bans paying people of different sexes for the same work. However, a lot of state laws have equal pay initiatives that go much, much further than that. They include things like salary history bans, pay transparency if you're posting a job. That's a huge area to be aware of, again, outside the FLSA, but within your state or states where you're operating. Another big area we've seen blow up is predictive scheduling laws, meaning with certain industries, you've got to give somebody their schedule in advance. If that changes, you have to pay them. It's not necessarily for all employers, but it's something to be aware of depending on what type of work you do. There's employer record keeping laws. What pay information on employees has to be kept? That's different than what the FLSA says. There are employer posting rules. The FLSA requires you to post a minimum wage poster, but there are also state poster requirements. So that just is kind of the point of this, is just to give you an overview of, you absolutely need to start with the FLSA and you absolutely need to comply with it. Again, a hugely broad federal law, but know that's the starting point. Know that you also need to look at what's going on in my state, what's going on in my city. Those are big, big issues. So you definitely want to check with us if you have questions on what the law is in a certain area where you're operating, if you are not sure. So how can we help you out? Ask us. We're always tracking the important changes with the FLSA related laws, you know, the exemption stuff, the minimum wage stuff, anything along those lines, compensable time. We're always keeping an eye on that. If you're not already receiving our weekly newsletter, make sure that you do subscribe to that. We provide weekly updates on issues that definitely relate to the FLSA or the state version, depending on where you're operating. And we can always advise you on the best way to handle FLSA compliance. Thank you, everybody, for joining us. Our goal is to make your life easier with answers you can rely on. Have a great rest of your day.